If you're joining me, I greatly appreciate that. I haven't done a live event in over a month, and I'm kind of a little bit foggy when it comes to this. So hopefully we have as normal amount of people as we usually have, a couple hundred, and on Fed Day, there's usually over 1,000. And I'm here to just basically answer any questions that you guys have. But what we're going to find out right now, well, in about 4 minutes, is what the Federal Reserve is going to do. So I like to share this screen with you when I do these, just so you guys can see what's going on in the market, how much the Federal Reserve's actions basically play a role in everything. You can see on your screen right here, this is the stock exchange. Right now, the stocks are up about 143. But you look at where mortgage rates are right now. So what I like to share with you guys is this, and let me blow this up a little bit for you so you can actually see this thing. Let me see if I can get a better version of it. There it is. So this is what we're going to watch as the Federal Reserve news comes out. This is basically what we're seeing on the screen is the bond that trades on Wall Street. If you're here, you're really interested in what the Federal Reserve is going to do. But our biggest goal here is what guidance they're going to give us. So we know basically, well, other than a few contrarians out there, the Federal Reserve is basically going to come in and raise interest rates by 0.75%. It's kind of baked in. But what they're going to tell us, their projections on what are they going to do in the next few meetings, that's what we're really concerned about. But you're going to watch this screen right here. Let me see if I can move myself over to the other side. So I want you to see this ticker. I don't think I can move myself around. So let me see if I can put myself at the bottom of this thing. Okay, so I'm out of the screen. Basically, what I want you guys to see is here's the ticker. What this ticker you're seeing in front of you is the mortgage-backed security bond. It's the price. So this is what you're seeing. When you watch my videos every morning, I show you a different version of this, but at least you guys get it. So if you're new to the channel, though, how or what determines your mortgage rate? Well, it's a bond on Wall Street. It's called the mortgage-backed securities. Here's what's happening to the price of the bond that we're seeing right now, right before the Federal Reserve announced what they're going to do. You can see basically the chart up here says it's down 22. We might see a huge move one way or another on this, and that's what's going to take effect right here shortly. Look at this. The news isn't out yet, but there's already trades being placed in that drive down the prices. So if this actually takes effect, we're going to probably see interest rates on mortgages go up at least 1/8 to another 0.25%. So while we're waiting for this, I want please add in any comments that you have. What I'd love to know is, as you're coming in, just let me know where you're coming from. Are you in California? Are you in Atlanta? Are you in Florida? Or where are you out there? And if you have a question for me, I'm here to answer any and all the questions that you guys have. If you have a question, please put it up on the screen. If you would, put a Q in front of your question. Just do like Q dash and then your question, so I know it's a question. But we're going to focus in on this screen. We're about 2 minutes from their decision on what they come out. So what's going to happen, what you're going to see, the Federal Reserve is going to actually leak it to the press, and everybody, not leaking it, they're telling it to the press. And then what's going to happen shortly after that, about 2:30, the Federal Reserve chairman is actually going to talk, and he's going to tell us exactly what he's doing and why they're doing what they're doing. But again, the biggest piece of this puzzle is what's the trajectory of what they're going to do in the future? Because already baked into the cookies, already baked into interest rates, there's basically a 75% increase in rates. But what we don't know is what their guidance is. And so if you follow my videos on a daily basis, here's my projection. They're going to come out today and increase rates by 0.75%. If they don't, you're going to see these numbers go completely crazy. I said bonkers the other day, and sorry about that for the Real Estate Mindset, great channel over there. He says bonkers. I love his channel. So if you want to find out for more information, check out his channel as well. But what we want to see is what their forward guidance is. So we know that the Federal Reserve wants the federal funds rate. That's their ultimate piece of the puzzle that they control up to a certain amount. Well, to get there, we need a 1.5% or 150 basis points increase in rates. So we need rates to go up 1.5%. So in this meeting, they're probably going to move those rates by 0.75. So that gives us 2 more meetings to do another 0.75. But we see that the inflation numbers are really starting to crack, and they keep saying, well, the jobs market is the big piece or the silver lining in all this. Well, really, is it? So you're starting to see a lot of analysts and people coming out saying they expect the unemployment rate to start ticking up and up and up. And that's a huge concern for us, especially going into a recession, or when people finally say that we're in a recession. So without further ado, let's get over to the big screen of this so I can get my head out of the mix and you could see tick by tick by tick what's going on. So the market's basically adjusting right now. You saw that we were down 22. Now it's starting to come back. This is what we have to contend with. I hate to say it, on a daily basis throughout the whole day, because rates have been so fluctuating over the last 6 months to a year. It's hard to figure out what the heck's going on. So I want to welcome those out there from Miami, Las Vegas, Texas, house completed in Nebraska, Tinley Park. You're right in my neighborhood. Let's see if we got anything else. Hello, these hikes in rates cannot be sustained, such as a short-term hike in stocks, for example. We will see rates. I hope you're true. Hope you're on that one. But let's get over to what the market's doing. The stock market is continuing to rally. I know this is suspenseful. I'm trying to get you guys the live feed. Usually CNBC will jump in here and they'll tell us what they're going to do. Let's see. The stock market just went from 120 up to minus 60. Big move. They might not like what's going on. Federal Reserve raises another 0.75%. So that's what we're seeing on headline news right now. So they did raise the rates by 0.75% as expected. But what we're going to teeter on here is what we're going to focus in on is what their future guidance is. So tomorrow's video, what I'm going to do is I'm going to show you guys or I'll do it later this afternoon. I apologize. Later this afternoon, I'll come out with a video going over the transcripts of what they told us. Basically, what we want to focus in on is the future guidance of where they are. Should be done now. So that's that. So let's get back to the MBS market. What's it doing? It doesn't like this data. Don't know why, because this number's already moved, basically adjusted into these numbers. And that's why we saw mortgage rates they're up over 150% from where we were just about 8 months ago. So that is a huge move in this market. So let's get over to here. We're seeing this. Is it going to stabilize? Well, actually, it's stabilizing on a downturn. So let's watch this for just a minute. If you guys have any questions on where I anticipate things going, the housing market, I like staying out of the house values, because no matter what I say, there's contrarians out there or somebody out there that just says you're wrong, or you're wrong. So what I want to focus in on the channel is basically letting you guys know if you're looking to purchase a house, in the next year, maybe what a good entry point is, or so forth. It's only you guys that determine, the best timing on all this and what prices you want to pay. So let's go through some of the comments that we're getting right now. Should have done more. 3/4 just announced. So I don't know why you're saying could have done more. They're not letting a lot of this actually trickle into and affect the markets. Inflation reading is in the 8s, but 1 to 2 should be done in a point. So we just saw the Federal Reserve has increased the federal funds rate by 0.75%. So let me explain to you guys what they just did. So let me throw me back on the equation. But this is a heck of a lot more volatile than we're seeing right now. We'll keep this on the burner for a second so you guys can focus in on that. But let me explain to you guys what the Federal Reserve just did. So a lot of people might think that what they did is increase rates all over the world, basically, in regards to what rate. So the question is that. So what they really did is they control one thing. It's called the federal funds rate. It's basically, it's kind of basically for me and you, it's a non-event. But for the markets, the corporate people and so forth, here's the effect that it has. Basically, it's just effect on banks. Truly, the direct effect is when a bank, at the end of the day, they have to have basically X amount in reserves. It's like maybe you have to have $100 in your checking account, or maybe you have to have at least $1 in your checking account for everything to work. But you try to cash a check and it bounced because you didn't have enough. So it's basically overdraft. So with the Federal Reserve, the federal funds rate is kind of like an overdraft protection for banks. At the end of the day, they have to have so much in reserves. So if they don't have that, they go out to this entity, and it's the Federal Reserve and other banks, to get how much money they need to cover their position overnight. The interest rate they pay on that is called the federal funds rate. So the Federal Reserve kind of controls that number. However, look at it this way. As the bank's costs go up, okay, they pass those along to everybody. So they're going to then in turn increase credit card rates, car loans, anything short term. Well, the one piece of the puzzle that a lot of people ask is, well, because of this, what the Federal Reserve is doing, is it a direct effect in mortgage rates? Well, the answer to that is no, they don't directly affect mortgage rates. However, what they've been doing for years and years and years and years, well, not years and years, but the last 2 years, and then back in 2008 and 10, they buy up mortgage-backed securities. So they buy up the mortgage bonds that are trading on Wall Street to drive up the price and drive down the yields. And if this is all confusing to you, please check out my YouTube videos that I do every day. You'll learn a lot, especially if you're in the market to buy your first home or maybe your first rental property. But guys, if you would, you're here, and I did the live events, and the reason why I do live events on Fed Day is so you guys can ask questions. Why did they do that? What do I expect them to do next? How is this going to trickle into the housing market? Here's the biggest piece of this puzzle. So let me explain to you guys on the housing front why I don't think, and I'll give you the data why, and if you need any questions answered, please ask, is why 2022, 2023 isn't going to be a repeat of 2008, 9, and 10. So let's look back in time, because I want you to be comfortable with, I know rates stink and house prices are crazy, and the Federal Reserve is really trying to taper that back down. But what happened in 2008 was this. A lot of loans that people had outstanding were subprime loans with teaser rates and teaser everythings. So what people did is they took out those loans in early 2000s. And then by 2008, 9, and 10, those adjustable rates, and these were all very bad adjustable rate, bad underwriting, bad programs. When those adjustable rates started to increase, so a lot of people that had those mortgages saw their mortgage payments double in the matter of a month. Okay, so that caused a lot of people to say, hey, I can't afford that payment anymore. So what do I need to do? Well, I can go out to my bank and see if they'll help me. Banks aren't doing anything because they know the market's crashing. They don't want any more assets on their books because their assets are already crashing. So basically the banks halted lending. Okay, so thus we had a huge housing crash. And because people were underwater, they didn't have a huge run of appreciation throughout the years. They didn't have enough equity in their house to do anything. So as they missed a payment or two, they basically owed more than their house was worth. So because the bank wasn't working with them and they couldn't afford those new payments, what do? So they have to sell the house. Okay, so that's what happened in those times. Today, what's the difference today? Yes, I know interest rates are sky high. I know house prices are way high, but people still have a demand for housing. And if they have a mortgage on their house, unlike they did years ago when their mortgage rate doubled because they had those teaser adjustable rates, is now most people have a 30-year fixed. Most of those 30-year fixed are in the 3% range. So your payment's never going to move unless your taxes on the house and your insurance goes up a little bit. Your payment's always going to be the same. So thus, in today's market, we still have people looking to buy, but they're like, I don't want to buy at these prices at these rates. So that is basically what's causing the housing market kind of adjustment right now. Not the crash that we saw back then, because the banks aren't shutting down. You're starting to see mortgage companies starting to close down. There's just no volume. We're actually in the process of hiring because we keep picking up a share in the market. So that's what I want to explain there. But if you have any questions, please let me know. Please put those on the post here. Again, if you haven't posted, let me know where you're coming from, because I like to cover everybody throughout from California all the way to New York to make sure you guys are served. The next piece of this puzzle is, where do I expect things to go from here? Well, I did a video the other day. It went over the last 10 basically catastrophic events that took place, and they were the Asian flu. I said Asian flu. I didn't say coronavirus. Recessions, wartime, and everything else. You should check out that video. I don't know if I can do it on a live stream, but I'll try to add it here. I went through the last 10 events that took place, such as those events, and what happened. Probably over 80% of those videos, what happened was the government overspent. Okay. We overspent today. They're overspending. What they're doing is they sent out tons and trillions of dollars to people. That's putting money into the system. Well, what did you do with your check? I know what my kids did with their checks. They spent it because we're a nation of spenders. I'm not telling you anything you don't know. So thus, you're going to push up inflation no matter what if you have too much money in the system. But then we're coming off the supply chain issues on products, as well as a lot of pieces of the housing market. So that's that piece of the puzzle. So we have way too much money or money supply in the system that the Federal Reserve is trying to pull that out. Okay. Another piece of this equation that's going to hurt things even more is what the Federal Reserve has been doing for the last few years is called quantitative easing. So remember I said that the Federal Reserve really doesn't control mortgage rates? Well, here's what they do. They go into the bond market, the mortgage bond market. You're going to see right here, okay, they go into this market and they start buying up the mortgage-backed securities. Okay, what happens when you have so many people or too many people trying to buy an item? It drives up the price to find an equilibrium. So what they did is they were going in buying $40 billion worth of this asset every month. So they were artificially driving up the prices. Okay, thus we saw a crash in the yields, aka mortgage rates. So that's what has happened. So now not only are they raising rates into this environment, they're doing a thing called quantitative tightening. And that's a completely reversal of quantitative easing. So now what they're doing is they're not buying up the market. They're not buying $40 billion in mortgage-backed securities a month. That's one piece of the puzzle that's drying up or causing less people to bid on that product. Okay. They're actually adding more supply to the system. So if you have way too much supply and no demand, you're going to drive down the price. And that's what we're seeing right now. There's no liquidity in the mortgage bond market. So not a lot of investors are looking to buy mortgage-backed securities right now. Thus, the price continues to tumble as we're seeing on the screen right now. So let's go back to it again. We're basically stabilizing right now at about down 28. Usually this is much more volatile than we normally see, but that's that piece of it. Let me see if I hope you guys can do a chat. If you guys have any questions, like I said, there's a cool feature. I'm using the new system right now, guys, and this will bring up your chats on the side. So I hope you can help me there. But let's see some of these comments that we're seeing. Should have done more, 3.4% announced. Okay, so I don't know what you're wanting for more, but I get it. You're probably looking for at least 1% adjustment there. I'm still on the side. I don't think. I think what they're doing is kind of okay, but they're way behind the curve. But they've already shocked the system. Look at it. Mortgage rates are up 150% in the last 8 months. 150%. I've never seen this in my 33 years of doing this business. So it's really bad out there right now. Okay, so let's go to the next question. Daniel, see rates dropping back down in the threes in the next 5 years? No. So let me go to these questions as they're being listed here. I will hide that on there. So we got a question in from Limitless. So we have Dan, do you see rates dropping back in the threes in the next 5 years? Think the future interest rates. So here's what I'm expecting. All right. I'm expecting basically the Federal Reserve to overdo it. And the markets might be doing it for themselves. Okay, so let me just repeat kind of what I said is the Federal Reserve, the economy is already bad. And how they keep saying that the jobs report is the number one, silver lining in all this. Well, if you really dissect the job market, it's not as robust as you think. Okay, so but they continue to say the only guiding light on this is jobs. Well, the jobs market is cracking, and now they're even anticipating the unemployment rate to get up to 4, 5, and 6% in the next year or two. I don't really look at a lot of those projections because the Federal Reserve and the government, their analysis of a lot of this is really bad. But let me answer your question. Going into this cycle, and again, I'll post the video down below that I did on 8 different cycles similar to this, is what happened was the Federal Reserve and the government overspent. Federal Reserve did it on mortgage-backed securities and bond purchases, and the government did it by just sending out way too much money. Okay, so that will push inflation. No matter what you see, I don't care if you take housing out of the equation, we still have huge inflation. Okay, so now they've seen that number go out of control. So now what they're trying to do is raise rates to kind of curtail the demand. Well, in the meantime, not only are they doing that, they're putting a double whammy on this thing or adding fuel to the fire by now selling mortgage-backed securities and other bonds into the market that's even pushing things in a worse position than we are now. So my analysis is they're going to continue to do this through the end of the year. And then as the Q4 of this year and Q1 of next year, we're going to be basically deemed that it is officially a recession, and everybody's going to announce that. So then normally what happens in a normal market from that point is the Federal Reserve realizes, oh man, we overdid things tremendously. So when people, make a comment by they should have done 1% or more, maybe they should give it a little bit of time because things don't move on a dime. Okay, so I'm expecting Q1 of next year for mortgage rate or for us to go into a recession. And then not farther on than that, I'm expecting the Federal Reserve to start easing or at least putting a brake on everything and starting to really come back down. One way they can do it just simply is just quit selling as much mortgage-backed securities as they have. That alone will kind of stabilize mortgage rates, and that's what we really need. So I'm expecting us to be in fully everybody where they'll verify, even if they keep changing what the definition is. I'm saying that everybody's going to say that we're in a recession by the end of the year. Federal Reserve's going to realize, oh man, we're basically crashing all the markets. So we got to do something. So let's start easing up a little bit. So that's my expectations there. Next question is, can we drop the messages? It takes up too much screen. Absolutely. Sorry about that, folks. Let's go over to this, and I'll bring up some of the questions down through here. My apologies, but thank you so much for coming on screen. Let's see the next question that we have. Where do you see rates? Let's see where you got. Where do you see mortgage rates Q1 of Miami, Florida? Just answer that. Hopefully I answered that question. I don't, I've never seen 3% rates in my whole life. So why did we get, the first question you got to ask is, why did we see 3% rates? Well, we had the coronavirus and the whole world shut down. No other, even world wars hasn't been as destructive to the economies as the coronavirus did. So I expect mortgage rates, once the Federal Reserve realizes they've overdone it, Q1, Q2 of next year, you're going to see rates stabilize. I still expect them to be in the 5.5 range. That's where I've been expecting them to be all along. And this is really throwing us a curveball. In my wildest dreams, did I think mortgage rates would hit 7% in 2022? If you would have told me that last year, I'd have said, you're completely nuts. And we're just a fraction off of that number right now. Let's see the next question. I don't have a moderator today, guys, so please bear with me here. And please watch your comments too, because I don't have a moderator, and I don't put up anything up there that you might regret. I don't know why they haven't announced recession yet. Whatever happened to I agree with you, but they're saying, well, a recession is 2 quarters of negative GDP, but there is some more pieces to that puzzle. There's more in the definition. It's a downturn in the economy. It's a downturn in this. But now what everybody's hanging their hat on is, well, the jobs numbers are good, so we can't be in a recession. Well, you're going to see a contrarian view to that here shortly. Next piece of the puzzle is, and thank you so much, guys, for the comments. Love it. And that's why I do this, just so you guys can ask questions and I can answer them. If I don't know the question or the answer, I won't answer it, but I'll at least kind of guide you to where you might be able to find the answer. Don't you believe that we have been in a recession just because they don't announce it? State that we doesn't mean we are not experiencing. Q1 announced a recession could be... So Q1 announcement of recession would do what? Them announcing a recession isn't going to do anything, because we're either there or we're not. Just because they say it, what will happen though is it'll be registered throughout, I guess, history that we were in a recession. But other than that, I don't know about you guys. I'm feeling the pain. I'm sure you guys are feeling pain. If you're a first-time home buyer out there, first-time maybe investor to buy a property, you're feeling the pain, not only in rates, but the asset value of homes is just out the roof. So for those that think I pump FOMO 24/7, that you have to buy a house, I don't, okay? You guys make that decision. Where I want to be your tool is, or your instrument, I'll put it that way, is if you need help with the financing piece. So I'm not doing a commercial right now, but I just want to give you my point of view. I'm a mortgage person. So there's a house that goes for sale. That house is probably going to sell to everybody. And everybody kept saying, why are we letting these investors come in and buy up the markets? Well, if you're not buying the house and the person wants to sell, they don't care who they're selling it for. And if you still have investors buying them, well, then the investors should buy it. Okay, so let's just look back. I don't think a lot of people realize, once you buy a house, your payment's not going to move. So if you would have bought a house last year, you would probably got a house at 15% cheaper than you would right now. And you would have got a rate probably in the 2s, or maybe just in the 3s, not 6.5. So, and that payment would basically never move. If you're renting, rents are going up on the tune in the last 3 years of about 10 to 15% a year. So where's it going to be 2-3 years from now? Yes, they'll start coming down, but we've already realized the pain. Okay, so that's that take. I'm trying to limit my answers because I know I talk a lot. The next question is, I think we can stop the recession easily. We just need to change the meaning of a recession. Yeah, just go into, I forget what's that website that you can go to and basically change the definition of things. Sorry, guys, I'm just going to flick one by one. So please watch your comments. They need to keep increasing rates next year because housing needs to collapse. Otherwise, people can't live. That's in its basic terms. Let's just look at the housing market in general. Yes, we need prices to come down. Is it going to crash? Well, here's my analogy of a crash. I'll be right on the screen and I'll say it. I see a crash of being like 40, 50%. Normally, I would see a crash about 20 or 30%. Why is my tune changed there? Well, we basically have between a year ago from today and today, we've seen prices go up about 12 to 18% in on averages. Some much higher, some a little bit less. Last year, we saw a 32% increase in homes. So, that asset class went way up. So if you went up, 35, 40% in 2 years or a year and a half, giving back 15% of that isn't a crash. It's just a correction. So if I see prices going 40, 50% below where they are now, that I deem a crash. Okay, so I don't think that happening, and I'm not hoping that the housing market completely crashes. But again, the reason why we saw a crash back in 2008-10, completely different reasonings than we have today. So if you want to find that out, just rewind my video about 10 minutes into the video, and I answered those questions. Greater good, haha, don't know what that means. I'll go to the next one. And we got interest rates and housing prices are doubled or more compared to 2008. If people couldn't afford it in 2008, I don't see it. So here's what happened. Okay, so let me explain this once again. Let's say you took out a mortgage in 2000, okay, and your rate was fantastic. It was a teaser rate, and your rate was 2.5%, and you're good to go. But 3 to 5 years later, that payment, your rate's going to go from 2.5% to maybe 8, 9, 10, 12. Okay, so all of a sudden, you're in the house, you're making your payments every day, and everything's peachy. And then all of a sudden, 3, 4 years later, you get this statement, and it's like, hey, your mortgage payment used to be $1,800, now it's $4,000. Everybody's going like, I can't pay $4,000. What do I do? Well, can I refinance? Well, no banks. If you remember at that time, you had Goldman Sachs and tons of banks going out of business. Banks. We're not talking mortgage companies. We're talking huge banks. Okay. So everybody's really reluctant to lend. So basically the lending field's shut down. We're not shut down today. We're open for business. Why most mortgage companies are kind of closing down. There's no volume. Back in those days, my phones were ringing off the hook. People wanted to refinance out of those bad loans. You couldn't. So if you can't refinance, what's your options? Well, you can negotiate with the mortgage company. That was called a modification. If you want to learn history, check out how the modifications used to work. They were non-existent. You'd send in your paperwork for months and months and months and months, and the bank would keep losing it, and then they just foreclose on you. So you look at it, see the difference there? At that time, you were forced to sell your house. Plus, let's look at today's market. If you bought your house in the last 2, 3, 4 years, you probably put down 5, 10%, maybe a little bit less. Over that time, you saw houses appreciate 50%. Okay, so now people have a ton of equity in their house. So now if their house payment does go up, if they still had that crappy mortgage from years ago and their payment doubled, they can easily sell the place. Okay, that's the difference between today and back when. And people don't get it. They keep watching these channels to say, well, 2008, home prices were sky high and they had to crash. Well, that's not how economics works. It's basically supply demand. So at that time, there was a huge demand for loans so people can get out of these shoddy programs, but no banks were doing them. Okay, so what happened is foreclosures started to escalate. Again, why? Is because they couldn't afford the mortgage payment. Okay, so now if you're in a house now, you're at a fixed rate, very few people have an adjustable rate mortgage, your payment's never going to change. So the only time you would be forced to sell is maybe if you have to sell, you get a divorce, you lost your job, you have to sell. But again, over the last 2 years, 3 years, you've saw about a 50% appreciation in your house. So you can sell your house, unlike what happened last time. So that's why foreclosures, if you watch my videos, foreclosures are a fraction of the market and a fraction of where they were even at the peak of 2008. So again, my goal on my channel, and the tagline I usually use a lot, is to inform and educate you guys. That's my whole purpose. I don't want to tell you how much prices are going to drop. I don't know. What I can do is say, if you finally decide that you want a mortgage, you want to buy a home, I would love to be your consultant to walk you through all the pieces of the puzzle and inform you guys. There's programs out there still that I would not take, and I can explain to you why. But that's that equation. So that was a lengthy one. Next one is, let's see. You know what? We might be live. Fed scores the latest 3/4 of a point. Yep, the reason. Let's see the next piece of the puzzle. So we might be. We've been on here long enough that we might be able to catch the Federal Reserve actual meeting, the context of it. My audio here, it's tough for me to share my audio. So what I'm going to do a little bit later, probably about 4 or 5 o'clock, I will post a video of the transcripts of what the Federal Reserve said and the differences they said this time versus last, because the transcripts that I'll post is basically verbatim is, last month's what they said and this month side by side, or not. It's going to be on top of each other. Then it's going to be read out what they changed in the verbiage. That's what we're really going to dissect in, because I want to see what their guidance is, what their projections are. What are they going to tell us? The market, what the markets don't like right now is uncertainty. So we knew this number, 75 basis points, was coming in. We basically knew that. A couple people said, 100 basis points, but that was off the table. But the future guidance is basically where we want to be. Let me tell you what will happen. If their future guidance is we're going to continue on this trend, we'll keep doing 75 basis points basically forever until this really cures. You're going to see the markets get hammered again, and you're going to see mortgage rates just spike, and they can hit 7 fairly fast. If they come out and say, okay, we're going to continue to monitor, this might be our last big adjustment, because we're starting to see some cracks in the foundation of the housing market is getting clobbered. But if we start seeing these effects affecting the jobs market, because the Federal Reserve has 2 mandates. The 2 mandates are full job employment. They want to keep the economy at full employment. What that number is, there's really no factual number, but they want it at a certain percentage, and price stability, aka inflation. So they're fighting inflation, but they can't take their eye off of the jobs market. They did say that they expect the unemployment rate to increase, but they don't plan on it getting out of hand. So those are all the components that we're starting to watch right now. And next piece of the puzzle is, if you're watching This Is Bonkers guy, you would be convinced housing is down 700%. That's what his channel is fantastic. A lot of these guys have great data. I don't know, I've been doing this for 33 years. So I try to give you the facts. Some people, they say that I FOMO real estate and I do that. Guys, just ask me a question. I'd love to answer it for you. But again, I'm going to get off the tune of, here's what's going to happen to prices, because we don't know. When you watch a lot of these channels, they tell you about how foreclosures are running. They're up 50,000%. Well, there was a foreclosure moratorium on for 2 years. So if you can't foreclose on anybody, you can't, basically. There was some, but very few. If you have one, or if you had one and it goes to 2, that's 100% increase. You get my point. When you usually have 40,000 and it goes to 180,000, now I'm concerned. But if it goes from 10 to 30, you have a 300% increase, I'm not concerned, because it's still that number is irrelevant. Okay, so that's that part of it. Let's keep going. But I love these questions. I quit doing these because you guys weren't showing up for a while. But if you guys show up, I'll be here. Fed obviously wants to hammer housing sector. Inflation, they created artificial. Yep. All related to industries such as Home Depot and the furnitures before oil goes back up. You hit it right there, Charlie. The oil prices, that's one piece of the puzzle that is really plummeting. We see oil down. I hope you guys are excited. I came on my way into work today, and gas here in Illinois, right outside of Chicago, is now at $3.90. We were at $5.99 probably 60 days ago. So that is coming way off. Let's get over to the MBS market for one last recap. So we have that market is, and I'll move this back here in a second, so just bear with me. So you're seeing the MBS market down 25. It's basically stabilized right there, which is kind of cool. Some days, if you remember last event, it was down. I think it went down 80 or 100. Those are big moves. But this move today will probably add an 8th to rates. Where are rates right now? We see rates coming at 6.47. So we're going to exceed 6.5%. We'll be more at the tune of about 6.625 here shortly. I never thought in my wildest dreams that we would be at these levels if you told me that last year. So my tune on housing is turning a little bit, because yes, if rates hit 7 or 8%, I'll find a video I did last year. I said that as a joke. If rates hit 7 or 8%, all bets off on this housing crash. And again, what I mean by a crash is there's going to be a ton of less buyers and so forth. So, there's no reason for a crash. And I wish people would get that through them. But the ones out there pumping this on the YouTubes, they're making a ton of money on YouTube. God bless them. But all the information there isn't really, precise. I guess I'll put it that way, because they're getting the clicks and they're making money off of that. And as you could see, most of them probably aren't. They're not in the mortgage business. They might be realtors, but they don't sell houses. I'm not trying to talk bad about anybody. What I'm just trying to say is they have their agenda is different than maybe just giving you 100% accurate information. So let's get to the next question. But I'll quit rambling. My understanding is that we will not see the results of the rate increase for 6 to 8 months. So why are the feds crank? That's my exact question. You got to give it time to, for something to happen. Let's say you're overweight. So I want to lose weight. Well, I didn't eat today. So why didn't I lose my 20 pounds that my goal was? You can't raise rates and in 3-6 weeks, the whole economy change, but it's changing pretty fast. Since the last Fed meeting, we're at the highest rates that we've seen since 2009, I think it was. So a long time. But they messed up, and they're going to mess up again by overcorrecting this thing. When do you see sellers adjusting their prices due to the increased mortgage rates? I am seeing sellers trying to sell 100K above what they paid a year ago. Those are the people that are going to get hammered. Okay, so what I think when you see a lot of these, and I used to have realtors on my show every week. Every one of them had the same thing. People were wanting this price when their house, my neighbor's house just sold for X. My house is nicer, so I should be able to get 50,000 more. Well, at that time, it was FOMO. I mean, FOMO. People didn't care. They were buying houses without seeing them. Now we're going to get back to normal. Okay, rates are up. The rates are too high right now. So if you love a house, I'm still at the proponent is if you love a house and it's going to be yours forever, try your best to negotiate with the seller and then give it a week, try again. Then give it a week and try it again, because as that house sits on the market, they're freaking out. Okay, so the prices are going to go down from the asking price. We're not really seeing a huge drop in values right now. We're seeing drops in prices or listings. So when you do your research, please make sure you dig into that equation. When they say housing sales have plummeted and builders are reducing their prices dramatically and so forth. Well, off of what? You ever go to the store and you see a thing, you go to TJ Maxx, if you guys have them where you are, you see, well, the normal price is $100, but I can buy it at TJ Maxx for 50. Is the real price $100? Or why is it at TJ Maxx? So that's my point. Let's get on to the next one. Many people have 3.5% rates are not selling. I agree, no matter what happens. Well, I'll take a little. Let me give you the side note of that. I agree with you. If I have a 2.65 on a 30-year fix on my house. Yeah, I got a mortgage on my house, and I basically mortgaged as much as I could. Why? Well, I'm paying 2.625. All right, I can have in the normal environment in the stock market, I can get 6-8%. On average over the history of stocks. So I borrow at 2.625 and I still have tax benefits for that. And then I send it out there and I use that money for an investments and my gains or my yields are 6 or 8. It's a win. So in this market that we've seen in the last 6 months or a year, it's not that case because what the stock market's doing and everything. But in general, over history, that's what you see. Let's go to the next question. I'll go through these until there are no more, I promise you. This. I don't know what you mean by this. So, Anthony, if you can let me know what this means, I'd love to answer your question, buddy. In my opinion, you are the most unbiased opinion I have heard on YouTube. Unfortunately, honestly, doesn't get clicks. I know it drives me nuts. Maybe just start hardcore clickbait to draw in people they haven't heard the truth. Here I'll give you guys the truth. You guys, you're my followers, and I greatly appreciate it. Some of my thumbnails might seem a little weird anymore. You're Zachary. You are dead on. I watch all these channels. That my competition. I won't say my competition. People in the same business as me. And a lot of the data they have is just they try hard, but the right now the who's making the most money on YouTube are the doomsayers. I'll just put it bluntly that I'm not on that fence, but a lot of my thumbnails might say, oh, doom and gloom, whatever. I need the clicks because without that, I can't have people see my content. And I hope once you see my content, you're going to say, okay, He's telling me what's going on in the markets, this. I give you all factual data. I give you the context that I'm using online, the charts, the URLs or websites that I'm using. Nothing's old data. We got to go back in history. That's how we learn things. When people ask me, what's going on, what's going to happen to rates next year? Well, how I kind of get a feeling for this is I go back in my database and my brain, what happened over the last 30 years I've been doing this, and I put a perspective on it going forward. And then people will yell at me, you're too old and you don't know this and that and this. Well, then I hate to say it, then don't watch the channel. But if you're out there, you really want the facts, please help me share this, help me post this. Do help me out if you guys would, because the more people that can learn this stuff, the better we all are. So thank you so much for that comment. I wish I could pin that thing. And so thank you so much. Next one. How about starting new builds in Utah? Would you wait out the market? I would wait. I would wait for you, especially Utah. I would wait for it to crumble a little bit more, give the builders a little more time to sweat. I would wait till Q4. Q4 is always terrible anyways in the housing market. Like in December, we just sit here and hope the phones ring. January, the same thing. Usually right at Super Bowl, everything kicks in. So what I would do, I would start working with or talking with the builder around December when there's no traffic, foot traffic. I know it's going to be freezing cold, and work with them maybe December, January when there's no traffic and it's even worse than it is now. And they're going to have tons of incentives for you. But the one piece of the puzzle, when you're working with the builder, I would separate my transaction. I would have them build my house, but not them control my mortgage, because that is a complete disaster for millions of people out there. Next piece of the puzzle, and I need you, Emily, play us 100 basis points. They didn't do 100 basis points. Where are you getting your information? They just announced it. They're doing 0.75%, and it is, let me get my head out of the equation just so you guys get it. Fed raises rates by another 0.75%. So it wasn't a full point, and I wasn't expecting a full point anyways. So let's get to the next question out there. I'll put that. Let me know how you guys, you want me side by side or you want me underneath so you guys can see the full screen there. Just let me know. Let's see the next question that we have. And I appreciate your unbiased info and data facts that you are providing with videos. Keep up the great work. Thank you so much. And again, if you guys would, John, I appreciate the comment. If you guys could, just make sure you give us a thumbs up, subscribe, and click the share button if you would. The more and more you do that, it helps the YouTube algorithms help us get noticed. And that's why I just did a class, actually a counseling service with, I don't know if you guys know Mr. Beast, but I actually hired his trainer, his YouTube consultant to help me. And there was a lot of things I was doing wrong. And that's why I kind of stopped my YouTube lives for a while, because I was doing intensive really training with that. And I finally just came out and it's like, I'm going to continue to tell people the truth, and no matter what, but I need help getting people to recognize or find our channel. So if you guys can help me on that, I'd greatly appreciate it. Next piece of the puzzle is, let's see, what is the new interest rate as of today? Well, this is before, let's see if I can get it. This is before the Fed announced what they're going to announce, and there's going to be adjustments to this. So I can see this going to 6.5 by the end of the day. Now, guys, just so you know, for those out there that are watching that don't watch me every day, this isn't my rate sheet. This is a rate that are published by Mortgage News Daily on a daily basis. Basically, it's an average of mortgages all throughout the country, the top 6 mortgage products that are used and the averages out there. So yours is probably, if you apply for a loan, it's going to be lower than this or higher than this. And that's why I ask people, once you get a quote from somebody, send me that quote. And I'd love to analyze that for you. We can scan your loan product or your loan assessment over 185. We counted them, 184 lenders throughout the country to make sure you're getting the best rate and terms. If you're not, we'd love to be your financial advisor on that, because we are federally chartered now, meaning I can do anywhere in the country. So I had a ton of people asking about New York previously. So if you're watching this or you're in New York and need some help with a mortgage, call us. We'd love to help you. Next question is, I've been seeing prices depreciation in Central Florida. Prices depreciation in Florida. I know what you're meaning. It depends, because I'm actually going to be there next week, so I won't have a video out next Thursday and Friday. I'm going down to my house down there, and I'll be doing some videos, but I'm going down there to analyze the market. I have several realtors down there that we're associated with, and I'm going to talk with them, and I want to get a feel for that market. But I'm hearing from some people that it's not, really deteriorating in some areas, and some areas it's brutal. So it's only going to depend on where you are down in those areas. But again, if you saw your house appreciate, 50, 60, 70% in the last 2-3 years, it's hard. how do I say this without being rude? It's hard for you to complain, that the house prices are going down. But if you're on the buying side of that equation, you're wanting those house prices to go down. So there's a kind of a catch-22 there. Next question that we have is New York real estate market is still seeing high home values. See, this is the context I love from you guys versus the world's ending. Every market is crashing. This is bad. That's bad. It's not. So you can see here, New Jersey, I got to put my glasses on again. Marcus is still seeing high home values and most listing getting at or above listing. Yes, no. Offers are less. Buyers are out there in less. It only takes one offer to sell the house. I love your context in that. Next question we have, I'm going to start flying through these. Federal Reserve is speaking. Let me see if I can see him.
And in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth.
This is what we wanted to hear. Hold on.
Trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
We'll go through one more question, but he answered. That was perfect timing. He answered exactly what I was checking. Here's CNBC. This is what I want to hear. Hope you guys can hear it.
The variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Well, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll.
Let's pause it there because he's not really answering the questions, and this is the vagueness that I was hoping not to have. Okay, so he came out in this. That was perfect timing. How much? When do you think that you'll start pausing? When do you think this is good? Well, he also said it takes time for all this to trickle into the market. So why are you increasing rates at an unprecedented level? Back to back to back, when you're not giving it time to settle. So that's my biggest concern. And then he said, well, the jobs market and this and that again. But he didn't tell us precisely what do they want the jobs, the jobless claims numbers to be. What do they want the unemployment number to be? There's no substance to this, and they're drilling him right now. So unless there's more substance, there's still going to be vagueness in the market, and that's going to basically freak out the markets. So let's go back to here. I just paused that. We're seeing the mortgage-backed securities bond. Look at this. This is pretty cool. Now we're flat. We're flatlined. Okay, so the markets are digesting his transcripts, what he's saying live and everything else, and they're digesting it and they like what they see. Let's see what's going on. I don't know if at the stock market. Let's see if I can go to the stock market piece of this to see what that's doing. Let's see. It's better just to go here. Stock market likes it, up 200. So we have the stock market rallying and we have the MBS market rallying. So they like the news here. We missed some of the context in his reporting. So there's something in there that they like. So hopefully my screen isn't black. Somebody just said my screen is black. Hopefully it's not black anymore. And if you guys have, I'm going to start just flying through questions now. So if you have a question, please let me know. And when I'm done with questions, I will sign off. But I greatly appreciate it. If you guys would, somebody on here said, please give guys, please, here it is. Make sure, please. Thanks, Fahid. I greatly appreciate it. If you guys would, give us a thumbs up. Do some transactions on here so at least YouTube finds those algorithms. Let's go to the next piece of the puzzle is, do you think housing in the metropolitan area in New York City will go down in prices? Yes. You guys saw too much of an increase in prices. But again, the biggest piece of the puzzle there is supply demand. How much supply is the area building? And how much demand is there? And that it's basically what you got to think of. Let's look at it this way. And you have a great question. A lot of the information that's out there is on a national level. So if we go, okay, the house prices are down, that doesn't mean they're down in your area. It is basically, you have to look at the whole country in a microscope. What is your town doing? Your city doing? Your state can be doing fantastic. Your town might be doing terrible. Here's a point that I would give people. I'm putting together a series of videos on how to buy your first house. One of the biggest things is I preach on there is use a realtor. And here's the reason being is we had Sir Ashley on our channel not too long ago, and he's down in the Carolina areas. And then we had some realtors out in Atlanta. And they're like, if you go out of Atlanta, you can go 10, 15, 20 miles out of Atlanta and probably find a good valued home. Same thing in the Carolinas as per Sir Ashley. So you have to really focus in on your area. That's what's hard for me to come out and say, oh, housing is going to do this. Because, I'm from a town called Fallensby, West Virginia. Probably never heard of it. Is there a housing boom? Yeah, housing's doing very well there. Has houses gone up 50% in the last year? No. So there's an equilibrium of supply demand in that area. So you have to really focus in on your area. How do you do that? A realtor. Okay, we can give you as much data as we want. You don't want, nor do you need the national averages. Okay, so you need to talk to somebody in your area. And if you guys are in an area that I don't know or that you're looking to buy in and you want some guidance, email me. We have realtors, basically relationships all over the country. Love to help you set you up with a reputable realtor. The channel wasn't to do an infomercial. It was basically to just answer the questions that you have. So I'll get back to that. Rate prices stabilize today. Well, no, the reason being behind that is, what's going to happen in Russia and Ukraine tomorrow? What's going to happen, here tomorrow? What's going to happen with the supply chain tomorrow? If Russia goes nuclear, what's that going to do? So today, snapshot right now, look at the market is going up 13. Whatever Federal Chairman Powell is saying in his congressional meeting, they like it. Okay, so that's what I'm going to say for that. So rate stabilization, we shouldn't really see this market this volatile, but we are. But please watch my channel every day. I try to educate you guys on what events are happening that day and the whys. Okay, so that's what my goal is to help you with. Should I lock my rate in since the Fed announced the rate hikes? You should have locked in before this. Because why? Well, because if you would have, if they would have came out with a 100-point adjustment in rates, you'd have saw mortgage rates hit 7. Okay, you would have saw them hit 7. We have a product, and we have several products. If you're still looking to buy a house, we have what's called a lock-in shop. You can lock in today while you're shopping. If you're building a house, we have long-term rate locks for that. You can go up to 6 months, no costs. Okay, you can lock in a rate. That is basically your insurance policy. So let me explain how it works. I'm a broker. I'm set up with, as I said earlier, 84 different lenders. So we lock you into that rate lock, that lock and shop or the extended lock, but we're going to continue to monitor. We'll continue to monitor your loan throughout the process. As we get closer and closer and closer to your purchase or your house being done, we'll keep reevaluating probably every couple of days to see, can we get you into a different a program or package with lower rates? And if we see rates plummet, what we'll do is we'll go to the lender that we're locked at. We'll try to renegotiate buy downs. But if it's cheaper and more cost effective for us to just move your loan to a different lender, that's what we're going to do. So we are your mortgage consultant. We're going to advise you and tell you and move and shake with the markets to make sure at the time you close, you got the best product and best rates that there are. Charlie, let's see. I know what your question is going to be. What do you think treasuries are going to peak? Best guess, of course. I don't, honestly. And when you're talking to people in the mortgage business, they keep telling you, all they talk about is the treasury yields. Treasury yields doing this. I don't focus on the treasury yields. Why? I focus on the MBS market. Why? Because this is my living. I do this. This controls mortgage rates. So there's usually quite a bit of a parallel between the treasuries and the mortgage-backed securities market. But many times there's a glitch, or when the Fed was buying up the markets and so forth, there was a disconnect on the two of those. So I focus in on the MBS market, and the reason being is it is the instrument that trades on Wall Street that does affect your mortgage rate. So I would highly suggest just watching my channel every day. You can go to Mortgage News. I have a subscription down below. If you want to subscribe to this service, you can do that down below in the comments section. There is a cost involved with it, but you can just, you can go to the, what is it called? Mortgage News Daily. They have a thing, or sign up for my newsletter. My newsletter is down below too. It might not be right now, but I'll add that to the video after we do the live. So you can go down there. You can subscribe to my newsletters. It's free. I don't sell it. You're not getting sold off for people to call you and everything else. And you can get all this data at the end of every day when you need it to kind of dive in on the market. So let's go through a couple more, and then I got to get going because I have about I have 3 new applications this morning. I think we just had a couple more come in. So we are busy, believe it or not. There is a lag on price corrections, but the prices will have to adjust. Rates are probably going to close by the end of the year. I don't think, I appreciate the comment. You might be 100% right. I don't see rates hitting 8 because that'll completely halt the market. And you got to think, what is the backbone of this country? You got stock market, you got banking. The bankers are going to start to complain, and they're going to start coming up with ideas and things to help kind of on the interest rate front. One big product right now is adjustable rate mortgages. And you might say, well, Dan, you've been saying in the past that adjustable rate mortgages are, basically no good for you. Well, no, I said the adjustable rate mortgages of 2008 were no good for you. Adjustable rate mortgages are fine today because they don't have all the bad features as they used to. And I got a video coming out on that as well. So great question. Next question we got is prices drops are 10% in Southern Florida area, excluding Miami. I haven't seen drops there. Price drops are 10%. Perfect. So thanks for commenting on that, because somebody did comment about the Miami market. So you're going to start hearing womp womp in the background, or cha-ching or whatever. That's the MBS. This is this. Every time you see these little orange things, I get an alert. These means some mortgage lender out there is changing their rates. So if you see these up here, we probably see, what does it say? Guaranteed rate, just raise their rates. So this is what tells me, and this is how I keep an eye on who's doing what, believe it or not. So there's a lot of pieces of this puzzle you don't know, and you don't really need to know it unless you're really in the mortgage business. Next piece of puzzle is, I'm a mortgage underwriter. Hey, God bless you. And business is slow right now. The fear of being laid off is real. I'm hoping the Fed shows things down before the profession is complete. And again, the concern here, I get your concern. I don't know who you work with or who you work for, but again, it's not right now. The problem in the mortgage business is there's nobody refinancing, because they have, their rates 3 or 4%. Rates today are 6.5%. So what are you going to do? You might want to pay off a lot of bills, with something, maybe get a home equity loan. And I'm working on for outlets to be able to provide clients with home equity loans. But right now it's basically there's nobody looking to put their toe in the water to buy a property because rates are higher than they've been probably since the people buying were teenagers, and prices are just crazy. But what you have to analyze is what's the alternative? Rent. Okay, so I don't know, if you're going to be in the house basically for 5, 10, 15, 20 years or plan on retiring there, try to negotiate the best you can and buy it. Because their rates will be coming down in the future. But to answer your question on that is, once the banks start feeling the major pain of this, they're going to go right to the Fed, complain, and there'll be some things done. Plus, it's an election year. So I'll leave it at that. I don't want to get into politics. Next piece of this puzzle is I locked 5.5 last Friday and buy down of 10. Is it a good decision? Do me a favor, if you would, email me that loan estimate. My email address is, let me see if I can get it up here. I don't know if I can or not. There's my email. So just email me your loan estimate. If you locked it, they had to email you a loan estimate. Please email that to me. Let me research it. The only thing I'm going to need from you in that email is what is your credit score. The loan estimate that you receive is going to give me all the rest of the information. So thanks for doing that. Demo, thank you. Powell just talked about committing. Powell just talked about the committee debating between. Okay, so the rest of the year. Okay, so that's good context. So what we're seeing here, remember before this, I said Federal Reserve they know where they want the rates to go to. They know where they want them to be. Okay, but what they're doing in the meantime is they want the federal funds rate to be at like 4.25. So they're saying they need to adjust 100 to 125 basis points more between now and then. They have 2 more meetings. So this tells me they're going to do one of 2 things. They're going to either raise the next meeting 75 basis points and then the next one 1/4. I don't think that's going to happen, but it's going to depend on a lot of this data. But what they're going to do is they're going to analyze the data coming in. I think they're going to be surprised on a good way, and they're going to come back and raise the rates 50 basis points or 0.5% next month. And then they're going to say, okay, maybe let's see what happens now. And then if they need to do another half in December, they will. But I think by December, we're going to really start seeing some cracks and some pain in the market that they were promising us. So that's my expectations there. I work for a major lender. I get more mortgage people on here than I think I do clients, or home buyers. I've been listening to you since you started a few years ago. How has helped me throughout the rough times. Thank you so much. That's what I'm here for. I don't care. I love if you're a loan officer, I have people saying, hey, I'm a brand new loan officer. I love your videos. Realtors doing the same thing. Then I still have those people out there that bash me on a daily basis that I'm an idiot and so much. Guys, there's a bazillion other YouTube channels. So I love for you guys following me, and I hope you enjoy the content. And I'm working harder and harder and harder to make that at least more enjoyable for you. So hopefully the context is a little bit better, thumbnails are a little bit better, audio is a little bit better, and so forth. So thank you so much for you guys doing what you do. So let's see what this one is. Let's go to, it's a good time to buy a house in Dallas now, or should I wait for next year? Is it good? You probably heard that clap. So the MBSs are now up 20. Like I said, here's what I would do. So I'll carte blanche this thing. Is I would sit on the sidelines for the next 30, 60 days. And I would just let all the sellers out there freak. I'd wait to see if what the Federal Reserve's doing is actually helping or driving down things. So what I anticipate is a lot of sellers are going to realize, oh man, I'm not going to get that crazy price that I was wanting. Not that it's really worth it, that I was wanting. So I'll drive it down to the point where I'm happy with my returns, or they might just pull it off the market saying, I really didn't need to move anyways. I'm just going to stay here. So I would wait for at least Q4 of this year to Q1 of next year, and then I'd really start digging in, because at that point, I think we're going to have enough cracks in the foundation to really start making sellers more aggressive, and the mortgage products and programs and rates getting much better. So great question. If I lock the rate today and it is in the process of closing in October, can I still shop? Absolutely, you can shop with another lender. It's like, so basically locking just means you're locked at that entity, at that bank or that lender. What I ask people to do every day is send me their loan estimate. we probably get 10 loan estimates a day. And on average, probably 8 of those, we can give you a better rate and a better term and better prices and better fees and better everything. Here's what's kind of frustrating. I'll be blunt, is when people come back to me and they use that, and I come back to them and tell them exactly what I can do. They then go back to that other company and says, here's what they're telling me they can do, and then they'll match it or do better or whatever. And kind of then, we get nowhere. Well, here's the way I look at it. Why didn't they give you a better rate at the time? So if you get a better rate with me, don't you feel like, if I wouldn't have called them out on this, they wouldn't have gotten me any better, and they would have actually taken advantage of me, maybe overcharged me or gave me a higher rate so they can make more money. But now I kind of called them out on it. Now they know they got caught. So now they're going to look and say, okay, well, here, we'll do better than that because we really want to keep you as a client. I say, screw them. They had their chance to offer you what they did. They offered it to you, and you can do better. Move on. Okay, move on, because what else are they going to, or what else are they trying to kind of cheat you on? I won't say cheat, that's a bad word. Kind of not do for you. And then, once you call them out and say, hey, I got this. Oh, well, I can do better now. Why didn't you do better in the first place? That drives me nuts. But if you would, send me a copy of the loan estimate that you have. And again, my email address is right here. And just send that to me. If you guys are out there and you're locked in, or you're in the process of a mortgage or right now, you can move. Okay. All it is you're locked in at that bank. Well, they can't relock you. They can't really do much anything. You should be stuck. So they shouldn't be able to renegotiate and do all this other stuff with you. So send me the loan estimate. If we can beat them, please move over to us and we'd love to help you. But again, I wasn't doing this as a commercial, but you guys asked. So and let's see, please send me your email. My email is up on the chart, and that I'm going to answer a couple more. I'm going to answer 3 more, and I got to get out of here. Next question is, will we see sellers financing more with higher rates? Will we see seller financing? Nah, and most of the times when somebody's selling a house, they got to sell it. They need the proceeds. Will somebody sell you a house, that they don't need the proceeds? That's going to be a seller by seller issue. But I don't know. That's a great question. I don't know the answer to that because, I look at it as most cases when people sell a house, I could be wrong. They need those funds to buy the next house, or they're going to rent it out. So thanks for that question. The next one is, thanks for informing us. Bought a house last year. Listen to you all the time. Past year. Thank you so much. And that should do it. Okay, guys, we are over an hour. I thought we'd be here for a half hour. I'm going to go do my due diligence on the Federal Reserve, what they did, what they're doing. And I'm going to put that into context for you and post that video either tonight or first thing in the morning to let you guys know what they said. And we'll break it down in the context so I can figure out, what's the next step for them and what's the next step in the housing market. So that is it for today. If you guys need any more from me, all I ask you to do is just shoot me an email. There's my email, and you can even call down below. I have representatives, all team members out there waiting for your phone calls right now to help answer any questions that you have. So thank you so much for watching. I hope you enjoy my channel. Please, as the other person said, please don't forget to give us a thumbs up, share this event, because only by doing that helps us get more and more viewers that we can help people buy their houses. So God bless, guys. Thanks so much for watching. I will see you tomorrow.